Hey traders, Raghee Horner here. Welcome to Charts and Coffee for Friday, January 22nd. Happy Friday, everybody. Hope the audio and video is good. Broadcasting live. All right, welcome. Got some hot coffee. We're in Viking mode today. What are we doing here? A little Valhalla Java. And we're going to take a look at some charts and take it from there. All right. Mohammed says, I want to be among the first. Well, Mohammed, my friend, you are, and welcome to Charts and Coffee. Great to have you here. Excellent. All right, so let's get to it. Now, for whatever reason, actually, you know what? Let me check something here. I actually switched browsers this morning to make sure that there we go. To make sure that the audio and video are in better sync, and it looks like it's working really well. So excellent. Thanks for your patience when we're going through that weird glitch between the timing, but seems to be really good now. So again, welcome. All right. So welcome, Mohammed. Good to have you here. Hey there, Kim, one of our regulars. Hey there, Kim. How are you? Which indicator alarmed you the most before the crash last February? Oh, which indicator? Oh gosh, no, none. I would love to say I was one of those people that said, oh gosh, I think macroeconomically it was full tilt, but you can be macroeconomically full tilt for a long time. There's no timing to macroeconomics. When I talk about macroeconomics, I'm talking about the four pillars: growth, inflation, monetary policy, and money supply. So really the trends of it, well, actually, let me see if I can't go back on maybe a monthly chart. I don't use monthly charts. I just want to kind of recreate the scene, if you will. So you're talking, oh gosh, I can't even get back there. But yeah, there we go. So really, if I had scrolled back on a daily, what would have got my attention? Breaking the wave, blue grab candles, breaking down to a red, going double red. Going double red would have been the first inclination, but the idea that once we go into a downtrend, it's going to be one of those panic downtrends. Yeah, I try not to engage in, we knew this then. That's selling newsletters. Yeah, I don't know, Kim. I do know this. Let me tell you the mistake I made, which is far more helpful. The mistake I made back then is once I understood the full scope of it. Now, you got to remember in 2008, at this point in time, I had already been trading a lot of years, and I had a lot of friends on Wall Street. I was advising a few hedgies and technical analysis, things like that. Nothing as sexy as it even sounds, but I knew people that were moving money around. I had buddies who were Forex traders that were moving around a yard a month, or more. A yard, by the way, is just slang for billion. Okay, that's all. So when I asked them, what's up, what's on your books, clearly not going to tell me everything, but I could tell something wasn't right. So anyways, the mistake I made back in 2008 is I pulled everything out of the market. I panicked. I pulled everything out of the market. I thought, you know what? Cash is king. I don't understand what's going on. This looks and feels worse than what I had experienced in 97 with the aging contagion and the Russian issue. Long-term capital management felt far worse. Long-term capital management back in the day, for those of you that either traded through it like myself or maybe read When Genius Failed, excellent book, Roger Lowenstein. You should read that. If you weren't trading in the mid to late 90s, definitely take the weekend to read When Genius Failed. I think I have it on this bookshelf. You can see behind me somewhere. It is the big short. It is the big downturn before we experienced 2008. So when I saw 2008, Eventually, I started to put the pieces together, but at scale, it was so much bigger than what I'd experienced before in my career. If I knew then what I know now, I would have not gone flat. I would have gone into more defensive assets. And that's what I want to kind of impart on you guys as we take a look at some of these monthly charts around that time. You need that big picture view macroeconomically. That is something that I incorporate into what I do in my newsletter. But by the way, a couple of you asked, you can check out it's free. It's a free newsletter. I should type that in, countdowntrader.com. You want to know some of the tactics I talk about. Really, really good. No fluff. Not my favorite trade. None of that stuff. No favorite colors and whatever. These are ideas that I think are really foundational to what you'll do. I think the last episode was about the calendar and how you want to think about positioning yourself in front of a Fed event, things that we talk about here in this room. Anyway, Kim, I don't know if that's the answer you're looking for, but the truth is, if any of us saw it coming, I guess there'd be a movie about us. Yeah, it wasn't an easy time to trade, because if you watch The Big Short, and you guys really should, it's probably one of the best trading movies out there. If you watch The Big Short, you'll realize that in hindsight, it looked like, Michael Burry's trade and things like that. It looked like perfect common sense. But if you recall, those guys were underwater for a really long time as the government and the Federal Reserve were pulling all sorts of shenanigans. You remember what the rating agencies were doing. Oh, gosh, I could go on and on because I remember living this firsthand. But yeah, I know that's not the answer you're looking for, but market trends begin the conversation, Kim. They always do. Probably something more accurate would be, hey, Rag, what did you do? Let me ask that question another way, if it's cool with you. And that is, well, Rag, what you do in it's a daily time frame now. Oh no, I want to go to the daily. What did you do earlier in 2020? What did you do in this? That's probably a better way to set that up, Kim. So if you want to study how to take advantage of an 08 type, what did it look like? That's kind of what you could study. Does that make sense? That's kind of what you could study. And all my cards on the table. March was my best month last month. I don't think everyone likes trading downtrends. My mentors made most of their absolute killings in downtrends. People like Stan Druckenmiller made most of their money in downtrends. Do not be afraid of downtrends and always have a way to recognize them. And the grab candles and these indicators that I teach you to use. Again, I hate to reiterate it, sort of like harp on it, but check out the newsletter because this is an ongoing conversation that we have here in the room, and definitely would extend over to the newsletter. But look at the grab candles. Look at the structure, because all downtrends start the same way. Some red grab candles, double red, propulsion dots, lower lows, lower highs, and then all of a sudden the wheels fall off the wagon. So I hope that helps. You could study February, March of this year and get a pretty good feel. But thank you for the question. That could be an episode, right? That definitely could be an episode. Mac, hey there. How are you, Mac? Mac's question is, oh, hey, Mac, new here, but I'm listening to Raghee for quite some time. Thank you, Mac. I appreciate that. Thank you very, very much. Futures are down. Am I going to short the market? No. If the futures are down, well, you guys know I'm always going to give you guys this straight up. The futures are down today. That means that some of my positions are probably going to be taking heat. We have very regimented risk management. It's based on a methodology that prevents a risk of ruin. What's risk of ruin? 50% down in your account, gang. So we have a methodology that keeps us at bay of that so that we still have enough to, continue trading. We don't have a ton of positions on right now, but I know looking at the S&P, looking at the NAS, it might be a bumpy morning, but pre-market doesn't tell the story. It tells the story. Where are we at 4 p.m. Today? Lots can happen between 9:09 a.m. Eastern and 4 p.m. Eastern. So I'm not going to take currently the down candle as anything more than, hey, be prepared to take some heat this morning. This is not a gap down. We are not trading lower than yesterday's low. We are just simply trading lower than yesterday's close. And the way it looks right now, if you zoom in a little bit, simply an inside day. Simply an inside day right now. All right. So, I just kind of mentally calibrate to know where my risk thresholds are and just buckle my seatbelt and be a big girl and know that I'm going to take a little bit of heat on the positions. And, I think the most important thing is to remain opportunistic, right? I've got a list. So I'm looking at my notebook. It's pretty empty right now. It's just starting for the day. But I've got a list of 1, 2, 3, 4, 6, 10 stocks, mostly healthcare and financials, that I want to get opportunistic in. So, look, if there's something you want to buy and it goes on sale, even if it goes on sale on a Friday, I'll probably think about maybe starting to build a position. So Rolex, like it. Happy Friday and coffee. I love it. MTCH, sure. Let's jump into that. Okay, Match Group. So what do you do with a freshly yellow market? What do you do with a freshly traded market, a yellow market? And that is, well, first of all, I don't have any skin in the game in Match. During the good stuff or now, what the problem is for me is it's a little close to earnings. I like to see runs into earnings, although we are seeing a little bit of an outgoing tide in terms of index, sector, stock approach. And really here, so if you're wondering what I want to see next, right? It isn't double green anymore, Stephen. What I'd like to see next are some nice blue grab candles. I'm not looking for the market to launch higher. And one thing I would highly recommend is go Google News. You don't have to get fancy about it. Go Google News MTCH. What's the chatter out there? Was this simply a brokerage downgrade? Is there a different narrative out there? What's the narrative behind that? Let the market simmer down inside the wave. Let's see some blue grab candles. And then next week's a brand new week, and we can assess whether or not a compressed market might give us a momentum breakout or a just more volatile correction. Could it look something like this back in September, October before it takes off again? But my path of least resistance would still be to the upside. So thank you for the question. All right, let's see. Hey there, Ann. Woke up this morning thinking what you have said so many times. Friday hates traders. Yeah, for those of you that may not know, Friday hates traders. What does that mean? Typically, trading on Friday is far trickier than trading on Monday. Trading on Friday is the end of something, the end of the month, the end of the quarter, the end of the day, right? The even end of the week. These are very different than the beginning of something. The end of something, I believe, is far, far, far harder to trade. So Friday does tend to hate traders. And you know what? Monday doesn't like us all that much either. But as long as we know not to overdo it on a Friday, like for example, this week, I kind of had a mixed bag. Last week was a great structured market. I think we had about 9 or 10 trades, day trades that we had went 100% win rate. That's not the goal, but it just happened to be a great day trading week. This week, yesterday I went 2 for 3, quick little wins in NAS and S&P, took a small loss in the Dow. The day before that, had a quick win in the Dow, quick win in the crude oil market, but it's been kind of inactive. I think by the end of this week, if I will have put on 6 or 7 day trades for the week, that will have been a lot. Granted, it was a truncated week, but that will likely have been a lot. So just based on the structure, based on the change of the administration, the inauguration, a lot of the concern politically about what might happen during that particular event. And there was some things that the market was probably waiting with bated breath. Janet Yellen's Senate hearing, what was she going to say? What is her tone? Market was kind of mixed about that. That event was not discussed enough in terms of broader coverage in the media. Shocker. Because I think that event alone did ruffle some uber bulls, uber buyers' feathers. And can you ruffle feathers on a bull? You can on this show. So I think a lot of times we'll start to look at the wrong thing. The inauguration wasn't the event. I believe it was Janet Yellen this week. And let's see if the market can sort of recover or calibrate to that. Because look, we're going to see money printing. Make no bones about it. A lot of what we're going to see going forward is still going to be supportive of the stock market, gang. But it might be in a different way. There's a lot of ways to keep the party going. It will probably be a little bit different, but I believe it still keeps the party going. But what we're going to see is a sort of recalibration of the narrative. And so I think it's not unusual to see some of the price action we're seeing. All right, Square is a position that I've got. Like I said, gang, every now and then we're going to take some heat. It's the way it is. When I look at the sum total of the positions we've had this month, the ones that stand out really positively were profits taken in, say, Exxon, Starbucks, Nike. We had a nice move in Nike. We're looking for some moves in TJ Maxx, Disney, Zscaler, Honeywell. There's some interesting names that I've got on my list here. We've got an old position, and I say old because the trigger was on the Dow, but the actual alert was on the 14th of December. We had a couple different fills along the way. Long DIA, right? And that's a longer term position we've had in place since the 21st. But what I have is February 19 option expiration, so I have time. So I guess what I'm trying to say is if you can slow down your pace until the particular zones that you're looking for are there, especially in January, don't let January get you down too much. January is an elusive market. A lot of times it starts off with some optimism from the previous month, from the previous year, the Santa rally, the window dressing, and then things get a little wonky mid to late January. So your two choices are to either sit on the sidelines or just put in really prudent trades, knowing that there's a seasonality in place. We've talked about that seasonality in this room. I've talked about the seasonality in the free videos that I do over at Simpler Futures. So keep that in mind. I'm looking forward to February. I think the markets are going to like what's to come. But sorry, I'm trying to see what time it is. All right. So I think the markets are going to like what's coming. And we should really keep that bullish bias, but be patient. So I like Square, though. I still like Square. I'm just going to have to accept that some of the moves might be a little bit more volatile than normal. The pullbacks may not be as quick, as springy as they would normally be off the wave. So I'll have to be patient. Do I have a limit on how many positions I'll on at one time? Russell, so this is always a tricky question. If the question is, do I have a limit? I really don't, because I don't have to anymore, and that doesn't help you. So the question is, do you need to have a limit, right? Everyone needs to look at their account size, right? Once upon a time, I did. I didn't trade the size account then that I do now. So once upon a time, absolutely. And it was always thinking if 50% or 75% of the trades that I have open hit their stop losses based upon what I teach in the Sector Secrets Mastery, would I be at risk of ruin? And that is not about how many positions. It's really another layer under that. It's what's the size of the position? What's the cost of the position? If I lose, what's the dollar amount that I lose? So there's a lot below that. It's very, very simple, third grade arithmetic, but it's asking questions a little bit differently to understand your proximity or your danger of being close to risk of ruin. So I don't necessarily have that issue as much anymore. One of the nice things about having a really big account to trade is I don't. It doesn't mean I trade recklessly or super large. I don't. It's just a nice cushion. So, but that's the process. And no, I don't focus on portfolio delta because I'm a trader. I'm not managing a hedge fund. I didn't wake up, as I like to joke, with Carl Icahn's underwear on today. Thank God. But no, I don't worry about portfolio delta because I'm not really managing a portfolio. My trades are going to be 3 to 4 days to 3 to 4 weeks in exposure typically. So I try not to really let longer term time horizon money management like hedging creep into my trading book. My portfolio is a different conversation. If this were not charts and coffee and this were instead, capital and coffee, this would be a completely different conversation in terms of portfolio management. But we're not managing a portfolio, right? We're managing a book of trades. So that's where I try to make sure that I'm not letting sort of hedge fund thinking creep into my trading. And I appreciate the question, but think about risk of ruin. Think about your threshold on each and every trade. And let's say 3/4 of those trades were to go bad because there's a more sustained downtrend. What would that leave your account looking like? And that's really the answer. That's really the answer, I believe, to that. And I hope that helps. Pfizer. Nope, I'm really not interested in Pfizer, although I am interested in a number of stocks in the XLV. And for those of you that are in the mastery, you're going to get a watch list from me today and a couple of different narratives about healthcare and what that means for the S&P and what that means for the Dow, likely today and into the weekend. So I'm looking for some of those sectors that are past the bulk of their earnings volatility, XLF being the other sector. All right. So yeah, Pfizer, no, it's I would prefer a double green. So let me give you an example of what I mean. We'll just take the number one weighted name in the XLV, and that's Johnson & Johnson. A different structure, right? Different, for me, completely different opportunity. So no thanks on Pfizer, but something like Johnson & Johnson would be more my preference. Hey there, Jordan. You just picked up Forex on 5. Oh, how cool. It's really interesting you mentioned Forex on 5 because when we launched the mastery, one of the things that was very much part of the idea, by the way, that's the newsletter link, gang. It's just it's a website or it's an email, however you want it delivered. So when we launched the mastery, which is what I refer to when I'm doing my options on ETFs and stocks, the other idea was, can this be a 1 hour a day thing? Can you situate your trading, your watch list, your alerts, and your entries in a way that you're spending 60 minutes or less per day? Because that's the goal that I have for me. And that Forex on 5 book was very much, how can I trade Forex 1 hour a day? And can that process that I created, that book's 10 or 12 years old now. Can that process that I created about a decade ago be applied to other markets? So yeah, pretty cool. All right, let me grab a few more questions. And I love that, Trisha. Thank you. It's a great book. Yeah, Bill, I agree. It's one of my favorite. Jeffrey. Yeah, you watched. Oh gosh, you had front row seats, my friend. I was still up in the, you were down in the arena. Wow. I'm sure you got some stories. Crazy times. But very profitable, I think a lot of people forget that downtrends are where a lot of these guys that we watch on television worth, trading billions AUM on assets under management, a lot of them will tell you, when do you make your money? Yeah, we do all right in uptrends. We make a killing when the market rolls over. So that's always been sort of, I think I was probably coached that way from one of my earlier mentors. Like, don't be afraid of gravity. Gravity applies, because think about it. We all buy for different reasons. But the short or the sell, let's talk about the sell, is, oh my gosh, I'm making money. Boom, punch the sell button. Or, oh my gosh, I'm losing money. Boom, punch the sell button. Panic is a far more predictable market emotion than irrational exuberance, as Alan Greenspan coined. Okay, so Pablo, I'm a big fan of Schwab. Anyone who's joined me in the webinars before our mastery launch will know that some of my favorite trades were Schwab. I love this trend. I will continue to buy pullbacks. It's definitely gone sort of accelerated. It's definitely gone in rocket ship mode, parabolic, if you will. But we'll continue to play that one for sure. All right, gang, let me wrap up. I tend to run a little over on Wednesdays and Fridays. My apologies, but I'm going to go head on over to my day job. I'm going to go log into our Sector Secrets Mastery Room and our Futures Room. Gang, we got a little something for everybody here at Simpler. Whether you want to, trade stocks and options and ETFs, whether you want to play futures, end of day swings like I've been doing in the currencies really nicely, trending markets. or whether you want to play day trading on the future side, figure out what hat you want to wear, when you want to wear it, and come join us in the rooms. All right. That's where I'm heading now. Have a terrific weekend. I will see you guys on Monday. Same time, same station. Be good to each other.